What if the entire global financial system, trillions of dollars moving across borders every single day, was built on something that technically doesn't exist? We're talking about the Eurodollar, a shadow currency of sorts, and the wild thesis that Bitcoin might be its unlikely successor. Let's rewind to the 1940s, when world leaders gathered at Bretton Woods and decided the US dollar would be king, backed by gold, trusted by everyone, the anchor of global trade. That worked beautifully until it didn't. And in 1971, Nixon basically said, forget the gold, and the world just went with it. Here's where it gets strange. Sometime in the 50s and 60s, offshore banks started holding US dollar deposits outside of American jurisdiction, creating what we now call the Eurodollar system. Think of it like a photocopy of the dollar that circulates in the shadows, not controlled by the Fed, not insured by anyone, but powering the entire engine of international trade and lending. The Eurodollar became the plumbing of global finance. Every multinational corporation, every foreign central bank, every cross-border loan denominated in dollars was flowing through this invisible offshore system. It's like discovering the world's most important river runs entirely underground, and almost nobody talks about it at the dinner table. Now, enter a guy named Jeff Snyder, and a growing chorus of monetary thinkers, including the analyst known as Jackson, who are asking a dangerous question: what happens when that plumbing starts to crack? Because since 2008, the Eurodollar system has been quietly shrinking, global dollar liquidity has been tightening, and the world is starving for a reliable collateral layer that doesn't depend on the whims of US banking regulation. This is where Bitcoin walks into the room wearing a suit nobody expected. Jackson's thesis, and it's a provocative one, is that Bitcoin isn't just digital gold for retail speculators. It's a candidate to serve as the neutral, stateless, programmable collateral layer that the post-Eurodollar world desperately needs. Think about what made the Eurodollar so powerful. It was trusted, it was portable, it was outside any single government's direct control, and it could be used as collateral to create enormous amounts of credit. Bitcoin, if you squint, checks eerily similar boxes. It's neutral, it's borderless, it's seizure resistant, and its supply is mathematically fixed, unlike the Eurodollar, which was essentially unlimited and is now unraveling. The historical irony here is almost poetic. We went from gold, which was too rigid and too physical, to the Eurodollar, which was flexible but secretly fragile, and now the thesis suggests we may be drifting toward Bitcoin, which is rigid in supply but infinitely portable. Each transition felt impossible until it was inevitable, and that's exactly what makes this either genius or completely delusional, depending on who you ask. Here's the misconception we need to kill right now. Bitcoin replacing the Eurodollar doesn't mean every trade is settled in Satoshis by Tuesday. What it means is that Bitcoin could serve as the base layer of trust and collateral, the way gold did before 1971. While dollar-denominated instruments are still built on top of it, cross-border lending and settlement would look fundamentally different if Bitcoin served as neutral collateral, no more counterparty risk from a single nation's banking system, no more Eurodollar shortages triggering global liquidity crises, the way we saw in 2008 and again in 2020. The systemic risk profile of global finance could, theoretically, become far less concentrated and far more transparent. Now let's be honest with ourselves, this thesis is still a thesis, not a reality. And the gap between Bitcoin as reserve collateral and Bitcoin as meme investment is enormous and filled with regulatory landmines. But history rewards the people who understood structural transitions early, not the ones who waited for the Wall Street Journal to confirm it on page 1. The practical lesson here isn't to bet your life savings on a paradigm shift that may take 20 years to play out. It's to size your position with humility, stay intellectually curious, and understand what you own and why you own it. Conviction without position sizing discipline is just gambling with a good story attached. What's fascinating is that the communities building on Bitcoin, the developers, the institutional adopters, the macro thinkers are increasingly speaking the language of collateral, settlement finality, and systemic reform rather than just price targets. That shift in conversation is itself a signal worth paying attention to, even if the timeline remains deeply uncertain. Discipline, sizing, and consistency are the only things that have ever separated investors who survive paradigm shifts from those who get wiped out riding the right idea at the wrong moment. Whether the Eurodollar to Bitcoin transition takes 5 years or 50, your process has to outlast your prediction. And whether Bitcoin becomes the new global collateral layer or simply remains a significant alternative asset in a world still dominated by dollar liquidity, honestly, both outcomes are worth being prepared for rather than caught off guard by. Rational preparation, not emotional conviction, is what puts you on the right side of history, regardless of how the story ends. If you want help getting started, whether that's real estate investing, home contracting work, or finding the right lenders to build your financial foundation, check out our links in the description below.